Hello, friends. Uh, Let us start. In this session, we're going to discuss the basic of accountancy through the debit and credit approach, or the double entry bookkeeping system, that as it is called. Before we go into that, let us look at some backstory here. There were three friends, Rancho, Raju, and Farhan. I guess all of you know about them. They dropped out of their engineering college and decided to start a business in Goa. Their plan was to buy T-shirts from wholesalers and sell them to tourists on the beaches there. Now, they estimated that they required around 40,000 rupees to start. Now, they themselves had 10,000 rupees each. So they were falling short of 10,000 rupees here. They went to their ex-director, whom they called Virus lovingly, and asked for a loan of 10,000 rupees. Virus was very happy that they've left the college and readily lent them their 10,000 rupees. These three guys were very happy. They had their capital now. They named their firm Three Idiots and Company. Now, out of the 40,000 rupees, 30,000 rupees was the equity or the owner's capital. 10,000 rupees was the loan or the debt or the borrowed funds, as it is called. Now, they decided that the business will have a separate identity, a separate books of accounts from their own personal financials. And that is normally how it happens. The finances of a business are different from that of the owner. The firm obviously will have its own books of accounts. The amount that the firm will owe to others is referred to as liabilities, and the things that they own is referred to as assets. Now, technically, the firm has nothing of its own. Even the capital that has been introduced in the business is a liability for the business. It needs to be paid back to the owners of the capital. Moreover, the profits that the business is going to generate also belongs to the owner. So the profit, let's say in a year, the profit that the business generated also belongs to the owners, and it's a liability for the business. So if we note down all the sources of the funds that the business has, like kahan se paisa aaya hai, that is liability, that is liabilities plus equity, that will equal to the application of funds. Kahan laga hai, kya kharida hai usse. That is the total assets. So we get this equation where liabilities plus equity is equal to assets. If we kind of flip it around, we've got equity. If you want to figure out how much equity the business had, or how much equity money, or how much share capital has been invested in the business, that will be assets minus the liabilities. Now, when we note this down, it is basically referred to as balance sheet. It tells us about the status of the business on that particular date. What are their assets, what are their liabilities, and what is the equity. So what Three Idiots decided to do is they also try to assess their financial situation as on 31st December 2019. They're going to start the business from 1st of Jan. They write down all their sources of funds, right? So they have a paid up capital of 30,000, debt of 10,000. And in front of that, they have cash of 40,000, which is lying with them, right? So the sources of funds is equal to the application of funds. Their liabilities are equal to their assets. In this case, when they note it on a piece of paper in a T format, we refer to it as balance sheet. They've started the business. The business is doing very well. Amongst the three, it has been decided Raju is going to maintain the books of accounts. What he does is he takes a diary and starts noting down all the cash outflow and inflow in various accounts. So in case, let's say there's a cash sale of 200 rupees, they sold a T-shirt. What he does is in the cash account, he writes sale plus 200. And in the sales account, he'll also write plus 200. So this is what he's doing. But as the business is growing manifold, there are a lot of transactions which are happening every day. And Raju is facing an issue. The issue that Raju faces with this plus and minus approach is that in case if he commits an error, it is very difficult for him to detect ki kahan error hua hai, right? So for example, if he did a sale of 200 rupees in cash, he's supposed to add 200 rupees to sales and 200 rupees to cash. But instead of adding, if he subtracts it, later on, it becomes difficult to figure out kahan pe kya problem hua tha, right? And similarly, this plus and minus system basically lacks internal consistency. Therefore, it is easy to get something wrong and be completely unaware that something has gone wrong. They again discuss it amongst themselves and go to Virus to discuss to figure out some solution how to maintain their books of accounts. Virus tells them about the double entry system of bookkeeping. He tells them that there is this debit credit system and it has a lot of internal consistency. So instead of using a plus or a minus, you start using debit and credit. So in every transaction, the amount of debit is going to be equal to the amount of credit. And if they are not equal, you would know something has gone wrong. Moreover, it's built on an inherently logical structure. We will see as we go ahead. He gives them some rules that there's never going to be one-sided journal entry, right? There has to be a debit as well as a credit for a journal entry to pass. For every transaction, there's going to be one journal entry, and there cannot be one-sided journal entry. Now, for every journal entry, for every transaction, the debit amount is always equal to the credit amount. Therefore, when you accumulate everything, the total debits is going to equal to total credits. Now, and every transaction must have at least two accounts. Every transaction must have at least two accounts. In a plus and minus approach, let's say you did a sale of 200 rupees, cash sale of 200 rupees. You wrote in sales, you wrote plus 200, but in cash you forgot to write 200 plus 200. Now, if it is a plus and minus approach, chances are that you might miss out. But if it's a double entry debit credit way you're doing it, then it's difficult for you to miss out. He tells them about something called as matching principle. He says a company will report an expense on its income statement in the year in which related revenues have been earned. Now, what does that mean? So, for example, he tells them that in case if you, let's say in a year, you buy 3,000 t-shirts. He had zero inventory, you had no t-shirts in your stock, and you bought 3,000 t-shirts, but you ended up selling only 2,500 t-shirts, right? So in your P&L, you're going to account for those 2,500 t-shirts ka sale as revenue, but in your cost, you're going to account not for 3,000 t-shirts, you're going to account only for 2,500 t-shirts. So the idea here is that the expense have to be related to the revenue that have been earned. Moreover, there are going to be some expenses which are not directly tied up to the revenue. Just for example, if these guys let's say rent a shack on the beach, they rent a shack on the beach. Now, irrespective of the sale that they do, they have to pay the rent. Right? Zero sale, they have to pay the rent. Lot of sale, they have to pay the rent. So in that case, because this expense is not directly tied to the revenue, it has to be charged periodically. Right? So if you paid rent for 1 year, and if you're making a profit and loss statement for that year, you're going to expense that in your profit and loss statement. It tells them about something called as the accrual system of accounting. The accrual system of accounting says that income and expenses are recorded as they occur, regardless of whether you've paid cash or not for that. Example, let's say you have an employee, you pay him a salary of 1 lakh rupee every year. There are three scenarios which are possible. He's worked for a year, 1 lakh rupee is due to him. Either you pay him 1 lakh rupee, first scenario, or you pay him 2 lakh rupees. He wants an advance, and you've given him next year's salary as well as advance. And the third scenario is you were a little short of cash. The company was a little short of cash and paid him only 50,000. Told him, and you tell him, you come next year, we're going to give you the rest of 50,000 rupees. In all the three scenarios, as far as accrual accounting is concerned, in your profit and loss statement, you're going to note only 1 lakh rupee as salary expense. You're not going to write 2 lakh, you're not going to write 50,000, anything. The idea here is that the expense that have occurred is 1 lakh rupee for salary, and it needs to be reported irrespective of how much cash we give out. Also, let's take another example. You did a sale of 1 lakh rupee. There can be three scenarios. In first scenario, you received a cash of 1 lakh rupee. In second scenario, you received 1 lakh rupee plus an advance. The customer gave you advance of 50,000 rupees. So in all, you received 1,50,000 rupees. And the third one is when you end up receiving only 50,000 rupees. The customer is your friend. He tells you, okay, I'm going to give it later. You say, oh, it's okay. So in either cases, in all the three cases, according to the accrual accounting system, we're going to note down sale of 1 lakh rupee. We're not going to note the noting down of sale, the journal entry for sale, the amount of sale is going to be 1 lakh rupee. So in case where we are receiving 1,50,000 rupees, right, we're going to receive, we're going to note down in sales, we're going to create another account called as advance received, which is going to be liability and account for that 50,000 rupees. In case where we've received less cash, we're going to create another account called as accounts receivable and receive and account for that 50,000 rupees. Then Viru tells them about the golden rules of accounting, which are very commonly used to teach double entry accounting system. But he tells them that this is a little complicated. He has a better and a simpler system, easier to remember system. And that is this. He says you need to remember two short forms, dead and relic. What is dead? Dead is debit increases expenses, assets, and dividends. What does that mean? So if there's an expense and it is increasing, you need to debit it. In case if there's an asset, it is increasing, you need to debit it. In case if there's a dividend, it's increasing, you need to debit it. Similarly, if they are decreasing, you need to credit them. And these, that is expenses, assets, and dividends, will normally have a debit balance, right? Next one, it tells them relic, which is revenues, equity, and liability are increased with credits. So in case you've got revenue, you're earning sales, you're doing sales, and they're increasing because you obviously when you do sales, they're increasing, you're going to credit it, right? In case of equity, if that is increasing, you're going to credit it. In case of liabilities, if they're increasing, you're going to credit it. In case all these three are decreasing, you will debit them. And all of these three will normally have a credit balance. We know every journal entry, the amount of credit is equal to the amount of debit. So when we kind of add all of that, total credits are going to be equal to total debits. The balance sheet always needs to tally. That is, the sources of funds, that is the liability, will be equal to the application of funds, that is the assets. Now all the liability and equity have credit balances. On the other hand, we've got assets which normally have debit balances. That is the reason the balance sheet should always tally. That is, the liabilities plus equity is always equal to assets. It tells them you need to prepare 3 financial statements. One is balance sheet, which you've already done in crude form. You know what it is. It tells you at a particular date what are the resources that a firm possesses. There's going to be income statement, which is going to give you all your incomes and expenses, and there's going to be a cash flow statement. An income statement is basically also called as your profit and loss statement. It tells you how much profit you've earned in a particular period. What is the process that needs to be followed? He says you need to characterize the accounts first. Then you need to pass a journal entry, prepare a ledger for each of those accounts, prepare a trial balance, and then at the end, you need to prepare an income statement, balance sheet, and a cash flow statement. So these are some of the transactions. These are all the transactions that 3 Idiots and Company did in their first 3 months of their business. They basically purchased 250 t-shirts at 100 rupees each, spending 25,000 rupees. Then they sold those 250 t-shirts at 300 rupees each. Collected, basically did a sale of 75,000 rupees. They paid around expenses of 15,000 rupees. They also paid interest to Virus. They borrowed 10,000 rupees and there was a 12% yearly interest. So the quarterly interest turned out to be 300 rupees. So let us see what are going to be the journal entries and how they're going to be posted in those particular ledgers for each and every transaction that they've done. The first one is they ended up buying 250 t-shirts at 100 rupee each and paid a cash of 25,000 rupees. Now, purchase is an expense for the business, right? You're purchasing, you kind of spending money. This is an expense for the business. And we know according to our debt rule, debits increase expenses. In this case, expense has gone up, so it needs to be debited. So the purchase account is going to be debited. Now, cash has gone down because we paid out cash, right? Debt says debit increases assets. In this case, assets are decreasing. So that asset account needs to be credited. In this case, which is cash account. So the journal entry is going to be purchases as account, debit 25,000 to cash account, credit 25,000. After you've passed all the journal entries, you need to prepare ledger account. So in the case, so every account will have its own ledger. So in this case, purchase account will have its own ledger. This is the T format. In this case, because it has been debited, on the debit side, we're going to write to cash 25,000. In case of cash account, we're going to write by purchases 25,000. In this cash account, we also have balanced brought forward. And the reason we have got balance brought forward is because they started the year, the first time they had already balance of 40,000 in their cash account. The next transaction is they sold 250 t-shirts at 300 rupees each and collected a cash of 75,000. That's a revenue that they did, sales that they did. So basically, asset is cash is an asset. It increased, so it needs to be debited. That's according to our debt rule. That is cash account debit here, 75,000 to sales account. Why sales account? Sales account is, according to our rule, sales account is increasing, and if it is increasing, it needs to be credited. Revenues are increased with credits, right? After the journal entry, we're going to prepare the ledger for each, right? In case of sales account, because it has been credited, on the credit side, we'll write by cash account, 75,000. It has been credited by cash account, 75,000. In the cash account, we're going to write, because cash account has been debited, on the debit side, we're going to write to sales account, 75,000. Let's go to the next transaction. They also ended up paying, they also paid expenses of around 15,000 rupees in cash, right? So expenses is increasing according to our debt rule. Because debits increase expenses, they are increasing, expenses need to be debited. So it will be expenses account debit to cash account. Cash account here is an asset and it is decreasing. So it's going to be credited 15,000 rupees. So what we have is expenses account 15,000 rupees. On the expenses account ledger, when we prepare, we're going to debit side, we're going to write 15,000 rupees. On the cash side, we're going to write by expenses 15,000 rupees. Right? On the credit side, we're going to write 15,000 rupees. Cash has actually gone down. Let's come down to the next transaction. They paid interest to Virus of rupees 300. So in this case, interest is an expense. It's increasing. You're going to debit it. That's what our debt rule says. Debit increases expenses. So in this case, it's going to be interest account debit 300 rupees to cash account. Cash is an asset. It is decreasing. So it needs to be credited according to our debt rule. So so after having passed this journal entry, which is interest account debit to cash account 300, we're going to post it in the respective ledgers. So in the interest account, in the ledger of interest account, we're going to write on the debit side to cash account because it has been debited. We're going to write to cash account 300. In the cash account, because it has been credited by 300 rupees, we're going to write by interest account 300 rupees. Let's go ahead. Then we're going to prepare something called as the trial balance. What do we do in the trial balances? We just note down all the accounts, list all the accounts, and we write down the debit and credit balances. Whatever is there, and as on that particular date, whatever is their credit or debit balances. We know the total debits have to be equal to total credits, because that's the bedrock. That's the way we've kind of functioned, right? And what is the use of doing that? The use of doing this or preparing trial balances, first of all, to check any mathematical mistakes that you've done. In case if you've done any addition subtraction mistakes in the accounts, the debits will not be equal to credit. Moreover, if in case we've done some posting, some errors in posting. So for example, instead of posting on the debit side, I posted on the credit side, or instead of posting in sales account, I posted in purchase account, something of that sort. This will get detected here because debits will not be equal to total debit amount will not be equal to total credit amount. After doing this, after having done that, we know in this case, our total debits is equal to total credits. We're going to prepare something called as the profit and loss statement. It will tell us what profit or loss we did in that particular period. In this case, it is for 3 months. So we prepare a T format, profit and loss account, right? On the first part, we're going to transfer whatever sales we have done, right? So we're going to transfer the credit balance that sales has. In the sales, we have a credit balance of 75,000. We're going to transfer it on the credit side of P&L or the profit and loss statement by passing the entry to profit and loss account, right? By passing the entry sales account debit to profit and loss account. So in this case, on the profit and loss account, on the credit side, we'll have by sales account 75,000. Similarly, we're going to transfer the debit balance with purchases to the profit and loss account. The expenses में जो debit balance है, that is 15,000 to the profit and loss account. Again, all the expenses account that we have, we're going to transfer it to the profit and loss account. What are going to be the journal entries for it? Let's say, for example, expenses account. Now, expenses account have a debit balance. We need to credit it in order to nullify it and transfer that balance to profit and loss account. So the journal entry will be profit and loss account debit to cash account, right? By doing that, we're going to transfer this. After having done this, so we have a sales of 75,000. In front of that, we've got these expenses, right? The difference between the sale, that is the revenue that we did, and the expenses paid out, is going to be our net profit, which in this case turns out to be 34,700. Even here, your total debit should equal to your total credits, and the difference between two is your profit. Right? In the case where, let's say, the sales here would have been just 25,000, in that case, it would have been loss, and the difference would have come here. The difference would have come here. After this, we're going to prepare the balance sheet. We're going to prepare the balance sheet. This was the balance sheet with the three idiots prepared when they were starting the business. That is on 31st of December 2019, before starting the business, right? So they ran the business for three months. Now they want to see where they stand. So they're going to prepare the balance sheet again. There have been no change in paid up capital. It still remains it still is 30,000 rupees. Debt again is still the same 10,000 rupees. The profit that they made, now the profit that they made, the business doesn't have anything of its own. All the profits that the business has made belongs to the shareholders or the owners of the business. In this case, so again, that is also a liability for the business. And this profit, net profit in the P&L, is transferred to your balance sheet as retained earnings. Basically, it's reflected in your balance sheet as retained earnings, because the earnings, they have not paid out any dividend, they have not distributed this profits. So the business, Three Idiots and company, need to pay 34,700 rupees along with their original 30,000 rupees to the three owners, that is Raju, Rancho and Farhan. On the asset side, it's a very simplified business. They haven't yet bought any large assets, any store, furniture, anything of that sort. All that they have is cash. So from the cash, you're going to transfer whatever balance in the balance sheet. We're going to write here 74,700. When I say transfer, we are not actually passing any journal entry or anything of that sort. We're just noting down the balances here, right? The balance sheet again has to tally, obviously, because the total credits, that is this credit balances, have to be equal to total debit balance. The total sources of the funds have to equal to the total application of the funds. So this is it. So this is the profit and loss. This is the balance sheet. Profit and loss for 3 months. Profit and loss account for 3 months for these guys, the Three Idiots and company. And this is the balance sheet for that particular period. So this is, in this session, we just covered the basics of debit and credit system. In the later sessions, we're going to go into more advanced journal entries. Moreover, the idea here is for you to, we don't want to be accountants. We don't want to be very deep neck into accounts. The idea is just to give you perspective. You need to know all of this, right? You might not be using it in your day-to-day analysis in case if you end up doing analysis work. There's a lot of accounting work is done in software and all, but you need to know how it happens. You need to know the basics. We are not going to go into a lot of details. In another session, we're going to just do some of these, a few advanced entries. That's it, nothing much. And then we'll also do analysis part and the other stuff. Thanks a lot, guys. Have a great day.